Lights up on a quiet suburban garage. A desk lamp, a man typing. Not the myth, the math. Here's the uncomfortable truth. Amazon didn't win because it sold books online. It won because it learned how to turn time into money, your time, suppliers' time, Wall Street's time, and then used that time to build a machine that never sleeps. Jeff Bezos didn't just build a store, he built a system that eats cash, spits out scale, and makes patience look like a superpower. Why does this matter right now? Because the same mechanics that made Amazon unstoppable are quietly reshaping everything you buy, every job you take, and every company that thinks it can compete. If you've ever wondered why some businesses feel inevitable, this is the story. Not the origin myth, the operating manual. Let's rewind. 1994. Bezos leaves a comfortable job at a hedge fund. He sees a chart. Internet usage growing at 2,300% a year. That's not a trend, that's a tidal wave. He picks books because they're standardized, easy to ship, and there are millions of titles. But the real insight isn't books. It's the idea that a store with infinite shelf space can beat a store with walls. That's the first lever. Selection. Selection brings customers. Customers bring data. Data improves recommendations. Recommendations increase conversion. Conversion lowers customer acquisition cost. Lower acquisition cost frees up cash. Cash buys more selection. That loop, selection, data, conversion, cash, is the early Amazon flywheel. It sounds simple. It's not. It's a compounding machine disguised as a website. Now the system. Amazon's early advantage wasn't just technology. It was finance. Most retailers pay suppliers before they sell the goods. Amazon flipped that. It negotiated longer payment terms with publishers and vendors, sometimes 60, 90, even 120 days. Meanwhile, customers paid Amazon immediately. That gap, the time between getting your money and paying theirs, is called the cash conversion cycle. Amazon made it negative. Negative means Amazon gets cash before it needs to spend cash. That's rocket fuel. Think about the math. If you sell $1 billion of goods and you get paid today but you don't pay suppliers for 3 months, you're sitting on a free float. You can use that float to build warehouses, hire engineers, cut prices, or just survive a downturn. Most startups beg investors for cash. Amazon borrowed it from the calendar. Bezos wrapped that mechanic in a philosophy. Lower prices, faster shipping, better selection. Not because it sounds nice, but because it increases volume. Volume increases bargaining power. Bargaining power improves terms. Better terms deepen the negative cash cycle. The more you sell, the more time you own. The more time you own, the more you can invest. That's the hidden engine. Then came the second engine. Prime. Pay a fee, get free 2-day shipping. It felt like a perk. It was a lock. Prime changed customer behavior. Once you've paid, you want to use it. You default to Amazon. That increases order frequency and basket size. It also smooths demand. Predictable, recurring, less spiky. Predictable demand lets Amazon optimize inventory and logistics. Optimized logistics lower costs. Lower costs fund faster shipping. Faster shipping increases Prime signups. Another loop, another compounding effect. Here's the irony. Prime looked expensive. Free shipping isn't free, but the math said otherwise. If Prime members buy more often, the fixed costs of warehouses and delivery get spread across more orders. The unit economics improve, and because Prime reduces churn, Amazon can forecast cash flows more confidently. Confidence lowers perceived risk. Lower risk reduces the cost of capital. Cheaper capital funds more growth. The perk was a bond. Now the part most people miss. Oz. In the mid-2000s, Amazon had a problem. Its retail business needed massive computing power, servers, storage, databases, to handle traffic spikes and holiday surges. Buying all that capacity and letting it sit idle most of the year is wasteful. So Amazon did something strange. It turned its internal infrastructure into a product. It rented out the excess. That product became Amazon Web Services. Oz is not a side hustle. It's a cash machine. Cloud computing has high margins compared to retail. It's subscription-like, sticky, and scales with customized growth. The profits from AWS subsidized retail's thin margins. That's the uncomfortable math. Your cheap toaster was partly paid for by someone else's server bill. And because AWS customers build their businesses on Amazon's platform, they become dependent. That dependency is a moat, not a castle wall, a gravity well. Let's talk about the marketplace. Amazon started by selling its own inventory. Then it opened the doors to third-party sellers. That move did two things. First, it exploded selection without tying up Amazon's cash in inventory. Sellers carry the risk. Second, it created fee streams: listing fees, referral fees, fulfillment fees. Amazon earns a cut on every sale, whether it owns the product or not. And if sellers use Fulfillment by Amazon, the company controls the customer experience, shipping speed, packaging, returns, while collecting rent on the infrastructure it already built. This is where power shows up. When you control the shelf, the search, the shipping, and the data, you can decide who wins. You can promote your private label. You can nudge prices. You can tweak the algorithm. You can make a seller's life easy or impossible. It's not illegal to be efficient. It's just effective, and effectiveness looks a lot like dominance. Now, the hidden mechanism behind the hype. Amazon's story is often told as a triumph of vision. It's also a triumph of capital discipline. For years, Amazon reported thin profits or losses. Critics laughed. Where's the money? The money was in reinvestment. Cash flow mattered more than earnings. If you can turn $1 of cash into $1.20 of future cash reliably, you keep doing it. You don't show profits, you show growth. Wall Street, hungry for a winner, rewarded that strategy with a high valuation. A high valuation is not just bragging rights. It's a currency. With a rich stock price, Amazon could issue shares to raise capital cheaply. It could pay employees with stock-based compensation, conserving cash while attracting talent. It could acquire companies without draining the bank. The market's belief became a resource. Belief funded reality. Reality reinforced belief. That loop is fragile if you fake it. It's unstoppable if you deliver. Let's put numbers to the feeling. Imagine a company that grows revenue 20% a year for a decade. Compounding turns small edges into big outcomes. If your logistics cost per package drops by 10% because you optimize routes, that savings multiplies across billions of packages. If your recommendation engine increases conversion by 1%, that's millions of extra orders. If your supplier terms extend by 15 days, that's billions in float. These aren't headlines, they're levers. There's also the tax angle. Not a scandal, a strategy. When you invest heavily in infrastructure, you get depreciation and other deductions. When you pay employees with stock, the accounting can reduce reported profits. When you operate globally, you can structure entities to optimize where profits are recognized. None of this is unique to Amazon, but Amazon did it at scale, with discipline, and with a long horizon. The result? More cash to reinvest, less cash lost to taxes in the short term, more runway to build. Now the tension. Hype versus reality. The hype says Amazon is a tech company. Reality says it's a logistics company with a software brain and a finance spine. The hype says Bezos is a visionary. Reality says he's a patient operator who weaponized time. The hype says disruption is about ideas. Reality says it's about execution. Boring, relentless, measurable execution. There's absurdity too. A company that started with books now sells groceries, hosts the internet, makes TV shows, builds robots, and delivers packages to your door while you watch those TV shows on a device it also sells. It's a mall, a post office, a data center, and a studio. And somehow, it still calls itself Day One. That's not humility, that's a warning. Let's break down the system step by step, clean and simple. First, acquire customers cheaply. Use selection, low prices, and fast shipping to make the default choice easy. Reduce friction everywhere. One-click ordering, saved cards, reliable delivery. Friction is the enemy of conversion. Second, turn customers into members. Prime isn't just a bundle. It's a psychological contract. You've paid, you want value, you stay. Membership smooths demand and increases lifetime value. Third, build infrastructure that scales. Warehouses near population centers, robots to move shelves, software to predict demand, routes that shave minutes. Every minute saved is money saved. Every dollar saved is a dollar to reinvest. Fourth, monetize the platform. Let sellers in, charge fees, offer fulfillment, sell ads. Yes, ads. Sponsored listings inside search results. That's high-margin revenue layered on top of commerce. You're not just selling products. You're selling attention inside your own store. Fifth, diversify cash engines. Oz funds retail. Ads fund logistics. Marketplace fees fund selection. Each engine supports the others. If one slows, the others carry the weight. Sixth, keep the cash cycle negative. Get paid now, pay later. Use the float to build. Negotiate hard. Scale gives leverage. Leverage improves terms. Terms deepen the float. Seventh, use market belief as capital. High valuation lowers cost of capital. Stock-based pay attracts talent. Acquisitions become easier. The market's trust becomes a tool. That's the system. Elegant, ruthless, effective. Now the uncomfortable math. If Amazon's average payment term to suppliers is, say, 60 days, and its average time to sell inventory is 30 days, and customers pay immediately, the company is effectively borrowing from suppliers at 0% interest for 30 days. Multiply that by tens of billions in inventory flow, and you have a massive, interest-free loan. That loan funds growth. It's not debt on the balance sheet. It's debt embedded in the calendar. If Prime members order, on average, twice as often as non-members, and their baskets are 20% larger, the fixed costs of logistics get spread across more revenue. Unit costs drop. Lower unit costs allow lower prices. Lower prices increase volume. Volume increases bargaining power. Bargaining power improves terms. Terms deepen the float. The loop tightens. If AWS operates at, say, 25–30% operating margins while retail operates at 3–5%, the blended margin looks modest. But the cash generated by AWS can be reinvested into retail's infrastructure, which improves retail's margins over time. The high-margin engine subsidizes the low-margin engine until the low-margin engine becomes a moat. That's not an accident. That's design. Contrast this with the hype. Amazon is killing small businesses. Reality. Amazon gave small businesses a global storefront and then charged rent, took a cut, and controlled the traffic. Amazon is a tech company. Reality. It's a tech-enabled finance and logistics company. Bezos is lucky. Reality. He made a bet on compounding and refused to cash out early. Luck favors the patient who can afford to wait. Zoom out. What are the bigger implications? For consumers, convenience has a cost. You trade choice for speed. You trade privacy for personalization. You trade local variety for global efficiency. The store that knows what you want also knows what you'll pay. For businesses, the bar is higher. Competing with Amazon isn't about building a website. It's about matching a system. Membership economics, negative cash cycles, logistics precision, data moats, and multiple cash engines. Most companies can't do all of that. So they specialize, or they sell through Amazon. And when they sell through Amazon, they become tenants in someone else's city. For workers, the future is shaped by the machine. Efficiency demands measurement. Measurement demands targets. Targets demand pace. The warehouse is a factory. The factory is software. The software is watching. That's not dystopia. It's the cost of 2-day shipping. For markets, Amazon is a lesson in narrative power. If you can convince investors that growth is durable, they will fund your patience. If you can deliver on that promise, you can build something that looks inevitable. But inevitability is fragile. It depends on trust. Trust can break. There are risks. Regulation is one. When you control the shelf and sell your own products, conflicts of interest are obvious. When you host competitors' websites on your cloud, questions about neutrality arise. When you dominate logistics, labor issues become political. Another risk is saturation. How many more Prime members can you add? How much faster can shipping get? At some point, physics pushes back. There's also the risk of complexity. Systems that rely on multiple engines can fail if one engine stalls. If AWS growth slows, retail feels the pinch. If ad revenue faces scrutiny, marketplace economics shift. If supplier terms tighten, the cash cycle becomes less favorable. If interest rates rise, the cost of capital increases, making reinvestment more expensive. The machine is powerful, it's also sensitive, and then there's the human factor. Bezos stepped down as CEO. Leadership changes matter. Culture can drift. Priorities can shift. The day one mantra is a guardrail. It's not a guarantee. So what's the real story behind Jeff Bezos and the rise of Amazon? It's a story about turning time into leverage, turning infrastructure into product, turning membership into habit, and turning market belief into capital. It's a story about compounding, small edges, repeated relentlessly, until they look like destiny. It's also a story about trade-offs. We got convenience. We gave up control. We got speed. We accepted surveillance. We got selection. We lost serendipity. We got a machine. We became part of it. Here's the unresolved question. If the future of business is systems like this, multi-engine, data-driven, finance-savvy, logistics-heavy, who gets to build them? Who gets to regulate them? And who gets to say when the machine has enough power? Because the garage is gone. The lamp is off. The math is still running.